Welcome to the Fund Your Retirement podcast.
Now and again, an explorer or a producer will find a huge amount of whatever they're looking for. And, a bit like Chalice did, it can be a real game changer. I think Chalice went up 65, maybe even more times. And, some of these other ones can do the same. And so, obviously you need a high degree of luck, but if you've got a broad portfolio, it increases the chances of achieving that.
Yeah, I mean, they're kind of crypto returns, aren't they? They're what people would be talking about in the crypto space, 65-time return. So
yeah, absolutely.
That's in the mining space. Hello, everyone, and welcome back to the Fund Your Retirement podcast. I'm absolutely delighted to be joined by Simon Popple from Brookeville Capital, where Simon and his team introduce investors to commodities. Simon believes commodities should be a core component of every investor's portfolio because, one, you can't print them, and two, they're the raw components that make up the things in our everyday lives. Simon has been a regular contributor to Money Week and frequently appears on IGTV as an expert guest on the commodity markets. Simon grew his £190,000 SIPP portfolio to over £750,000 in 9 months using the investment strategies that he shares in his weekly report, the Brookeville Intelligence report. This will be the first of a 2-part interview with Simon, introducing investors to commodities so they can diversify their portfolio and retire earlier. Hello, Simon. Thank you for joining us.
Great to be here.
It's really, really good for you to take out the time and join us. One of the ways I like to start off the podcast is I like the guests to share their journey. How did they go from where they were to where they are now? You've got a successful business, the Brookeville Intelligence report, that specialises in commodities. Where did Simon start out? How did you go from point A to point B?
No, sure. Well, I mean, going right back to the start, I started in marketing, did the MBA, worked in the city doing corporate finance, and then moved over to property. Did pretty well in property, to be honest. And in 2008, I left. I was a director of one of the world's largest private property companies, and I left that, set up Brookeville Capital. And since then, I've written newsletters for Money Week and Agora, who are the world's largest newsletter provider, and invested in commodities because after property, I was really looking for the next big thing. And my view is that it's commodities, and I think all these things are cyclical. And I spent probably the last 10, 15 years investing in this sector, and I've done very well, and I'm very happy about it.
So why, you mentioned they're cyclical. Obviously property, I can see, during the 2000s, property was a no-brainer in hindsight. Why did you then go into commodities? You mentioned cyclical. Did you see something back then?
I mean, if I'm honest, I never thought interest rates would go as low as they did. But obviously, they have done. And, as you say, hindsight's a wonderful thing.
Yeah.
But what I like about commodities really is, you can't print them. And, they're used in everyday life. And I think, in this day and age, you want to have a diverse portfolio, but I think that it makes a lot of sense to have some of your capital in investments that can't be printed. And I use globally. I mean, you could take a bar of gold anywhere in the world, and it's viewed as valuable. And you don't need a computer and things like that, like you probably do with Bitcoin. And so, I like the idea of having some commodities in your portfolio. And if you look at how cyclical markets are, property, it's difficult to see how, unless you got in a while ago. Now is a good entry point, and I think commodities actually is quite a good entry point. So I'm sort of delighted to be working in the sector.
Yeah. Why do you still think even now there's still a good entry point? What's your sort of thoughts on that?
Well, if you look at the Goldman Sachs Commodity Index, it's over the last 25 years, commodities do seem to be one of the few asset classes that aren't in a bubble. And as we were saying, hindsight's a wonderful thing. You never really know what a bubble is until, But that chart would indicate commodities, could potentially go significantly higher from where they are. Also, I'm very worried about inflation, and I think that the fact that commodities are used to make stuff, I think there's a perfect hedge for inflation. But if you're investing in something that is going up in value because of inflation, then it does offer you, a degree of protection.
Yeah. And you mentioned inflation there, and obviously that's tied to, in part, the money printing as well. That's kind of going on globally and has been going on for the last 10 years. And I guess also as well, the decline of the dollar plays into that, as well as commodities are priced in dollars.
Absolutely, yeah. I mean, a lot of commodities are priced in dollars. So if the dollar value goes down, you can't print them. So the commodity value, probably goes up. And especially if you look at energy and things like that, I think there's some fairly nasty shocks around the corner in terms of energy, and probably food as well, in terms of how much some of these commodities are going to cost, and therefore how much our heating bill and food bill could be in the future.
And you think that? Do you think that's tied to the inflation? You think that's?
Yeah, I do. It's there's many different components to inflation. I know that I think Chairman Powell recently sort of almost retired the word transitory, and
he did. Yeah, it's removed from the language.
Exactly. It's obviously when the pandemic ends, you would hope that certain sort of segments of the market, supply chains open up and there's less inflation in certain areas. But I think there's a lot of structural inflation around. Yeah. And, if it's running, I think they're talking about 6-7% at the moment, it's difficult to see how it's going to come down unless they increase interest rates. And
which also has another negative effect.
Well, exactly, yeah. With all the debt out there in the world, and also property prices, if you increase interest rates, it was interesting. I think somewhere the government of the Bank of England was talking about increasing them from 0.1 to 1%, which doesn't sound like very much, but that's actually a 900% increase.
Yeah.
And so, if you've got a mortgage and the mortgage provider sees the base rate increasing by 900%, it'd be no surprise if they increase their rates, and that could hurt people.
Yeah. So commodities covers a broad range, from the foods we eat to the raw materials of the everyday things we use today, to gold and silver and platinum. Do you have a particular area of commodities that you focus on, or is it more you just look for value across the whole space?
At the moment, I'm focusing on what I call hard commodities, which are really commodities that you don't want to put in your mouth. I started off with gold and silver and precious metals.
Yeah.
I've now got a decent portfolio of those. So I've been moving on to areas like lithium, copper, uranium, and I'm building up a portfolio there. I was very fortunate. One of the ideas I came up with, which was a chalice, I sort of told people about it when it was around 15.5 cents. It went to over $10. So that creates more money that people could invest in other sectors. So the idea is to broaden that out to hard commodities over the next year, 2 years, and then go into soft commodities. That'll probably take another couple of years. So over time, people have a very diverse portfolio across a wide range of assets. But I'm really using the gold and silver and PGMs at the moment as the engine room for diversification. So if they go up 5, 10, whatever it is fold, then it creates more capital to allocate elsewhere.
Yeah. You mentioned lithium, uranium, PGMs. Am I presuming that's something to do with the green energy transition in there? Is that part of your?
I mean, it's lithium is very hot at the moment because everyone's talking about electric cars and things like that. And long may it continue. We've got
no, it's certainly going to. Yeah, I agree with you on that.
We've got a few in the portfolio that are doing very well. Well over 100%. But for example, this week I told people about a zinc company. It's the highest grade zinc company in North America and one of the highest grade in the world.
Yeah.
And zinc is actually non-toxic. You can charge a zinc battery in 15 minutes.
Right.
It's very early days. But it's if zinc, a university in South Korea has developed a zinc battery, and if it proves to be commercial, then
zinc is going to become.
So unfortunately we don't know. But I think what I'm trying to do is give people some diversification. So a bit of zinc, a bit of lithium, a bit of uranium. No one really knows what essentially the new gold is going to. Sorry, not the new gold, the new oil. Because everyone's talking about phasing out oil and coal. But if that's the case, you've got to have something to replace it that generates the power, the energy, whatever it is.
Yeah.
And so is that going to be lithium? Is it going to be zinc, uranium? No one knows. But I think having some of them in your portfolio,
in each one. Yeah. So, are you investing directly in the commodity themselves, or are you actually investing in the miners themselves?
I'm investing in the miners because they're the people that are basically getting it out of the ground. In some cases, I use a fancy football format to explain what I'm doing. But on the one hand, you've got goalkeepers that are sort of established producers. Defenders are probably established producers, but not as large as your goalkeepers. Midfielders tend to be new to production, and forwards tend to be out-and-out explorers. So the way I kind of talk to people is, I've got bits of everything. I invest in everything I tell people about, and so I've got a nice spread of producers, new producers, explorers, and now and again, an explorer or a producer will find a huge amount of whatever they're looking for. And a bit like Chalice did, it can be a real game changer. I think Chalice went up 65, maybe even more times. And, some of these other ones can do the same. And so, obviously you need a high degree of luck, but if you've got a broad portfolio, it increases the chances of achieving that.
Yeah, I mean, they're kind of crypto returns, aren't they? They're what people would be talking about in the crypto space, 65-time return. So
yeah, absolutely.
That's in the mining space.
What I particularly like about it as well is, I look at Australian, Canadian, and US. So you've got a bit of an FX protection across the US dollar, Canadian dollar, and Australian dollar. So if people are, let's say, all in UK property, they're very tied to sterling. And I like the idea of having a bit of FX diversification as well. And not only that, but also across different commodities. So if people have got a bit of rare earth, a bit of gold, a bit of silver, they're not completely tied to any particular asset.
We've got different jurisdictions as well, haven't you? If you've got a mining company in America and a mining company in Australia, you've got different jurisdictions as
absolutely. And I tend to focus on what I would view as safer jurisdictions, which is why I focus on those, because I don't want to wake up in the morning and find out there's been a coup somewhere and the gold mine is
been taken over by the government or something.
Yeah, and that does happen.
It does, yeah.
So that's one of the reasons I like to focus on safer jurisdictions, because I think there's greater chance that you can invest properly and not sort of lose your shirt.
So I mean, it seems that what you've been sharing so far is it's relatively you're looking for the main safer jurisdictions. You've got a diverse portfolio. You're minimizing the risk by doing all these different steps, but yet commodities has this perception of risky. What are some of the misconceptions when it comes to investing in commodities then?
Well, I mean, commodities are volatile, and I'm actually a pretty conservative investor, to be honest.
Yeah, you definitely come. I can see that. Yeah.
And I mean, people sort of, when they look at, I increased my investment from 195 to 790, we must be taking huge risks. But, I was lucky. I had Chalice, that went up 65 times. My portfolio went up 3.
Yeah.
But the perception of commodities is that they're volatile, and they are volatile. But if you've got a diverse portfolio and you're in different jurisdictions, different commodities, different companies at different stages of the cycle, I view your explorers more like venture capital and your defenders more like private equity.
Yeah.
Then you can manage risk, and I think in this day and age, you're an investor if you like it or not. And I think that's the big change from probably our parents and grandparents' generation, because they probably retired and just sort of kicked back, took out an annuity and just did nothing. But it's an interesting fact I found out the other day that Warren Buffett, I think, is worth 81 billion or over 81 billion dollars. But the vast majority of that he earned over the age of 50, and I think it was 70 plus million was actually over the age of 65. So
wow.
I think that the world of retirees is changing, and I think that people are going to have to think about how they want to invest their money and be a lot more proactive about that investment than perhaps their parents or grandparents used to be. If you're smart enough to make money, you're smart enough to work out how you want to allocate it. And I think that diversity is very important. You do want to invest across asset classes, and I think it makes a lot of sense to have at least some of your capital in commodities, because it's an asset class that is overlooked by many, and logically, people should look at it.
Yeah. And let's hypothetically say someone's starting now. Then, what would you say they need to get started, apart from the fact they could join your Brookeville Intelligence report, which I think would be a very good step in the right direction? What else would they need to get started?
Well, obviously you need capital.
Capital for one thing.
Money. Yeah, I think the other thing that's important is you want to have a platform that allows you to invest in Australia and Canada. Some platforms do, some platforms don't. And I think you also need to have a tax efficient wrapper, so invest in an ISA or SIPP, SAS or something like that. Because if you get a goodie like Chalice and it goes up 65 times, you don't want to worry about the tax.
You want the tax efficiency of that, don't you?
Exactly. So if it's in a tax efficient wrapper, then that's nice.
So the Brookeville Intelligence report, a tax efficient way of investing through one of the large regulated entities, and then capital. What sort of minimum would you say?
I would say, I know it's very difficult because everyone's different, but I mean, I think 10 grand is not a bad sort of benchmark, because you want to probably have 1,000 in, let's say, 8 stocks. As I say, I'm quite risk averse, so I like the idea of having a bit of cash just in case there's a market correction. But I think if you've got 8 stocks, it gives you a bit of diversity, and also if you're buying or selling, it's probably 20 quid in, 20 quid out sort of thing. If you've got £1,000 in, then obviously you need it to go up to cover those costs, but it's not a crazy amount percentage-wise up. Whereas if you're only investing £100 or something, and it's going to cost you £20 to sell them, then it's got to go up by 20% or 20% on the way out plus 20% on the way in. So you're talking about 40%. Even to wash your face. So
just to cover the commissions.
Exactly. So I think about £1,000 per investment is probably not a bad starting point. And if you've got at least 8, I like people to have a lot more, to be honest, but I think 8 is probably the minimum that you should think about.
Yeah, no, it's brilliant. loads of really great gems of information in there as far as I'm concerned. You know, as we come to the end of the part one, this chat, what's the kind of the big takeaways that you'd like the listeners to get from this episode?
I think the main one is you should definitely look at commodities. You know, whether it's through meal, something else, you know, please look at commodities. That's the first takeaway. And the second one is, if you do decide to go into that area, then look for a platform that allows you to invest in the space. You know, I use Interactive Investor. You know, obviously, do your own due diligence and an investment platform that you like. But just because your platform doesn't allow you to do it shouldn't discourage you. You know, you should, if you want to invest in the sector, then you know you should be able to do it without too many problems.
Brilliant. That's excellent. And part two, we're going to take a deep dive into Chalice as a case study, and also break down Simon's approach in kind of how you actually evaluate the areas and the companies. So part two will be a lot more detailed on the investment approach. And I hope you've enjoyed part one and a good overview and introduction to getting started in commodities. Thank you very much, Simon.
Thank you very much.
Thanks a lot. Speak to you in part two.
Cool.
I hope you enjoyed the video, and if you haven't subscribed yet, go ahead and subscribe to our YouTube channel. And you don't have to stop there either. We have more videos on the screen for you and lots more insightful content on our channel and at our website fundyourretirement.com. I want to thank you very much for your time, and I'll see you in the next video. Bye for now.